Good morning, ladies and gentlemen, and welcome to the show this Friday, the 17th of December, 2021. Thank you for tuning in. Glad to have you guys here. Now, here's the thing I want to say. What the central banks are doing right now with their tightening, I believe it's a policy error on an unprecedented magnitude. And it couldn't come at a worse time. Sure, the markets didn't react a lot yesterday, guys. They didn't react a lot yesterday, but they're starting to react today. And I'm going to tell you, it's going to continue. Things are going to continue this downward trend. And the longer the Fed goes, continuing to stay by this policy, before they break off with this and go back to more free, easy money, the more free, easy money it's going to take to pull everything around again, to bring things back up again from the drop that they're creating right now. If they just stay the course, they could have drugged this out a lot longer. But by doing what they're doing, creating this drop, they're going to create a drop. Then they're going to have to support that drop. They're going to actually speed the hyperinflation up. It's going to come quicker from what their policy actions. Anyway, let's get in there and let's take a look at some things that are going on. Let's take a look at the charts. Let's open up the charts right here. Take a look at what's going on. Chinese central bank does not want to save Evergrande. Not at any price. They're letting her go. And yes, there's going to be contagion. There already is contagion. Other property developers in China. And banks are linked to Evergrande. And an awful lot of people, their fortunes are linked to Evergrande. It's sliding down, and the Chinese economy is linked to the world economy. It's the second biggest economy on Earth. As their property market starts to slide, the valuations will start to slide with it. And we're talking trillions here. Just a 10% slide in the Chinese property market, which is not that much, really, would probably be something like in the order of $5 trillion. Gone. Poof. 5 trillion with a T. Not billion. 5 trillion. This is what we're talking about here, and the impact that would have on the world's economy. But, it's probably that would be a best case scenario, considering what's happening right now in China. And, look at what's just happened to Turkey. Turkey halts all stock trading as currency disintegrates. The central bank is powerless to halt the collapse. And this is the position that all the central banks are going to be in. The same position that the Central Bank of Turkey's in right now is coming to all the central banks within a very short period of time. Probably within the next, it's not going to be we're not talking 10 years from now. We're probably not even talking 5 years from now. We're talking all the central banks are going to be in this same pickle, and it says the central bank is powerless to halt the collapse. What we're looking at is a collapse. It's a collapse of the fiat currencies of the world. The fiat currencies are going down, guys. They're going to go down hard in the next few years. And you just can't transfer all of that wealth from one place to another suddenly, or you get chaos in the world. And also, it's dragging all the wealth out of the majority of people that live, majority being the average citizen. It's dragging the wealth right out of your pocket through a hidden tax called inflation. Meanwhile, it's enriching the rich and upper class are being enriched. So this is a wealth transfer from all of us. Everything we got is going to them. That's what's happening right now. Everything we got, all of us, the people, it's all going to them. And that's going to create chaos. It can't do anything else. But, you just cannot. This doesn't know where to stop either. The poverty doesn't know where to stop. It doesn't know where to draw the line. And we got raging pandemic. and I mean raging right now, moving through with this new variant at a speed unprecedented. It's going to be, it's going to get kind of a little bit on the crazy side very soon, the speed that this thing's progressing at. Yes, I'm watching London, and I'll tell you why I'm watching London. I'm watching London because they're ahead of everybody else except for South Africa, and they are a major Western city, big city like New York and San Francisco and all these other big cities are a big city. London's big, and you know they're way ahead, and I'm watching to see just exactly what kind of damage it does in London, because that's the kind of damage we're going to be expecting in other Western cities. We're just going to have to watch and see. Maybe it'll blow over, or maybe it won't. Maybe it'll cause, we just don't know yet. We're going to have to wait and see what it does in London. So I'm still watching London. It's only been a day since I told you guys that I was watching London. I'm still watching London very carefully, but this is going to take probably a couple weeks to unfold in London. But we're only probably a couple weeks behind them everywhere else. So that's why I'm watching it very carefully for you guys. Next thing I want to take a look at is the silver price today. We're seeing silver took a little bounce up, and silver's really holding good today. It's up 9 cents at 22.56. So that's good. It's staying above $22. That's what we need to do. That's what we need to do, guys. It needs to stay up there. Let's take a look at gold. It's up $8.50 at 1807, so it's cracked above the $1,800 mark, and that's good. Really good for gold and silver. Let's take a look now at cryptos. Cryptos is 2125 in billions. So it's 2,125 billion for the entire industry. Now let me refresh the page. So it's 2125. Now it's 2148. So we just had a little jump of about, I guess $20 billion in the last few minutes since I refreshed the page. So it's going up. You know, crypto goes up. It goes up really fast. It moves awful quick. It can move awful quick. Anyway, we're looking at a Bitcoin price of 46,353 today. Now let's take a look at the Dow Jones, which is off 408 points on the day so far. Down 408 points at 35,489. I guess it's starting to sink into them that the Fed's determined to remove the punch bowl. So what the Fed's going to do is they're going to continue to remove the punch bowl to a certain degree, a little bit. They're just pulling it away a little bit. It's like, picture the guy, he's been in the punch bowl all afternoon, it's on the table, and grandma comes over and she pulls the punch bowl back about 4 inches away from him. You know, it's still there, but he has to reach a little bit farther to get it. You know, and she says, in the next little while, I'm taking it away completely. That's what they're trying to do. They're not going to get away with it. They're the only things that's been supporting this market all along. It's cheap, free, easy money, or low, cheap, easy money. So they're going to get away with as much as they can get away with doing. Let's put it that way. But they're not going to get away with it because ultimately the markets are going to go down at a certain point. The more brazen the Fed gets, like right now, they've entered into this a little bit, but give them a little bit of time, and if nothing happens, if the markets stay up, they're going to get more brazen, and they're going to keep pulling. They're going to keep pulling those blocks out. It's like a big game of Jenga until the thing falls. They're going to keep going. And, you know, they're going to keep. And when that happens, then they're going to have to turn around and go back the other way again. And that's going to be it. Game over. See, they have to be proven that they cannot possibly fix this. They keep coming out, okay, we're going to fix it. But then it has to be proven that they can't fix it. So right now they're in this thing where people say, well, the Fed's cutting back. They're going to fix it. And there's still a little bit of faith out there. That faith has to be ultimately completely pounded to powder so that there's no faith anymore. And that's when we're going to really see things happen. Once that faith's completely gone. So right now they're in this mode where we can do it. And they're out there, we're tightening. See, look, we can do it. Well, let's just wait and see. but I think this is going to end in complete and utter failure in the end. Anyway, let's take a look now at the oil price. Down $2.05 at 70.33 today. Move index 69.10. Now see, the Fed's tightening has helped stabilize the credit markets right now. And this was up near 90. Now it's at 69. So that's quite a substantial drop. Drop is good. It means the credit markets are stable. And so this tightening has reinforced the dollar somewhat and made the credit markets much more stable. Let's take a look now at bonds and rates. Now, I notice these yields have been dropping, and we're getting a 10-year now at 1.39, which is incredibly low. And we're looking at a U.S. 30-year at 1.82, which is really low, at down 3.4 basis points. Now let's take a look at the U.S. dollar index at 96.30, and you see the dollars being stabilized and buoyed higher by Fed action. This is all going to end in disaster, but it's a ways away yet. It's still a ways away. I mean, it's not right on us. Right now, we're still dealing with the pandemic. I think when the disaster really comes from the financial system, it's going to be when the pandemic is completely in the rearview mirror. Not completely in the rearview mirror, but it's going to be not like it is now. Like right now, it's front stage, front and center. I think by the time the real panic occurs in the financial system, that the pandemic will be back there in the rear view, still be there, but in the rear view. And what'll be happening is this will take front and center stage. The financial crisis that they can't fix. They can never fix it. That's because all the money is created from credit. Getting real to the real fundamental of it. All the money is created from credit. And what they do is when they create the money, what they call money, which is I'm talking mostly about the dollar. But it's all the same thing, depending on what country you go to, these central banks. As they create the money, what they call money, it's created on a loan. It's created on debt. And the thing is they never create the interest to pay. That accrues. It builds up. The interest grows bigger and bigger year after year after year. They never created that money. They only created the base money, that what they call, or currency. But that's all a creation of debt. So you pay the debt back, all the money disappears. There's no money. Or what we call money. It's gone. Poof, vanishes. And at the same time, we got this phenomenon going on where cash is becoming more and more of a scarcity all the time because people just don't use it anymore. Not very much. Not like they used to. Cash used to be everything. Every transaction was in cash. When I was younger, there wasn't no guy come up to the line and pull out a credit card. There's very few people who even had credit cards. Then later, more and more people had credit cards, but they didn't use them that much. They were like special for special occasions or whatever, when the credit cards first came out or whatever. And you had to have, you had to qualify to get one that was a lot more than it is now. It's like now they're everywhere. But back then, you used to stand in line to buy something. Everybody used cash. Now, very few people use cash. Cash is disappearing from the system because they don't need so much of it. They don't need to create as much of it. And so what's out there is all these digital units, which is basically just a digital ledger. But the way this functions is, like I say, you've got this ledger of debt against the ledger of digital monetary units. And the ledger of debt is 10 times bigger because of all the fact that they never created the monetary units needed to pay off the debt. They only created the monetary units which are attached to the debt. And so this digital ledger out there is how everything operates within the system. It's an enormous ledger. The computers basically update it. So like if you take $100 out of your bank, the computer updates it. Now you got 900 instead of 1,000. And they're just making ledger entries. But all of those digits out there are all completely overwhelmed by that astronomical size of the debt. So if you pay the debt off, all the digits disappear from the system. Now, the money that they created in cash would not disappear. It would still be. So you see, if you own a $1, just a $1 American bill, say, or it doesn't matter, it could be a Swiss franc, or it could be a Canadian dollar or Australian dollar, or it doesn't matter. If you got an actual physical bill you're holding in your hand, it could be a Great British pound note. You're holding that in your hand, right? That is not like the rest. It's not like all the digital units you got in your bank account, because that's been created into the real world as a note symbolizing the digits that are that you would have in your bank account. That note's real. It's real. It's tangible. It doesn't have the counterparty risk associated with all of these other notes. That counterparty risk is associated with the debt. So if all these other notes disappear from the system on this digital ledger, you would still have that note that would be real in the real world. The problem with that is if that were to happen, so I know some of you guys out there are saying, well, if the system deflates by 90%, I'll still have, if I have some cash, say some actual cash, and I'll be okay. Because that'll be worth a fortune then, because when all the other digital notes have vanished from the system because of the debt, then my cash I'm holding in my hand will go up 1,000 times in its value. And yes, technically that's what would happen. But, I know you guys hate to hear the word but. I hate the word but myself. But, what would happen is the system would completely lock up. And you wouldn't have anywhere to spend your cash. Because once the system completely breaks, then everything's basically closed or worse. You know, it's in other words, chaos would ensue. And there'd be no place to spend your money, because the only reason your money actually, I'm talking about your cash that you saved, there'd be no place to spend it, because the only reason it has value is because the government gives it value. And if we were to go into a Mad Max world, there wouldn't be any government to give it value anymore. This is the whole thing. So that argument, see, about everything's going to fall by 90%, so I'm going to save some cash. The problem is everything falls by 90%, the whole system's just basically going to crack apart. In fact, I figure it's going to crack apart if it falls by more than 40 or 50%. If everything crashed by more than 40 or 50%, it would all start to just break to pieces. So it's not going to go that way, guys, because the central banks won't allow it. I believe that they've got it somewhere around a 20% drop. If everything drops by about 20%, they're going to step in. You watch them. You get a 20% drop in these markets, and they're going to step back in. They're going to say, oh, we made a mistake. They've already admitted that. That's why the markets didn't drop a big amount, because in the notes coming from these last meetings that they had, you know, they're always having meetings, and Jerome Powell was talking and stuff and everything, and everybody's recording what he's saying and everything else. I was in there reading those notes last night. And it says right in there, they're not going to let the markets fall out of bed. They're going to step in. But then that's at the expense of their credibility then when they do that. It's going to be game over when they do that. So basically, we're just waiting now for the inevitable, which is for the Fed to completely lose credibility, because these markets in the up and coming months, depending on how the central banks are going to be tight, they're going to stimulate that to happen. This is game over. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the next episode. Bye-bye.